Hello and welcome back to Accounting 102. This is the second review set of questions for our midterm. So we'll jump in and start going through the questions. The questions were posted on Blackboard. Hopefully you had a chance to attempt them before you watch this, but either way, some good review to get you ready for the exam. Again, the exam covers chapters 1 through 6. There's 23 questions on the exam, 150 points. You'll have 75 minutes to complete it. You have to use HonorLock, so there's some links under the exam folder to help you kind of get that set up. There's also a practice, so if you want to practice and make sure you have the right setup for HonorLock, you can do that as well. The due date is Friday, March 13th. At 11:59 p.m. That's the cutoff, so you have to be complete by then. So if you start it at 11 o'clock Friday night, you only have 59 minutes to complete it. You won't get the full 75 minutes. And again, there's tutoring available and some other review sheets, and there's the link for that. It's also linked in Blackboard. So we'll get into the questions. Sales commissions are classified as: are they product costs, period costs, indirect labor, or overhead costs? The answer is period cost. Typically is a variable cost as well, so on the cost volume profit income statement, it shows up in the top part in the variable cost in the contribution margin section. Given the following data for Sandhill Company, compute A, total manufacturing costs, and B, cost of goods manufactured. So if we have these data points, these amounts for different costs, we will calculate our total manufacturing cost first. And manufacturing costs are direct materials, direct labor, and manufacturing overhead. So 785 is our total manufacturing costs. And then cost of goods manufactured, we take our beginning work in process, 30,000, add our total manufacturing cost that we just computed, and subtract our ending cost of goods inventory, so our ending work in process inventory, and our goods manufactured is 800,000. So the answer is C, $785,000 of total manufacturing costs, $800,000 cost of goods manufactured. 3, the sum of direct material costs, direct labor costs, and manufacturing overhead incurred is A, cost of goods manufactured, B, total manufacturing overhead, C, total manufacturing costs, D, total cost of work in process. We just saw that this example in the previous question, it's the total manufacturing costs. So direct materials, direct labor, manufacturing overhead incurred, total manufacturing costs. Number 4, determine whether each of the following costs should be classified as direct materials, direct labor, or manufacturing overhead. So A, we have depreciation on factory equipment. So which bucket would that fall under? That would be manufacturing overhead. B, table legs used in manufacturing tables. That's direct materials. Can't very well make a table without legs. C, wages paid to assembly line workers. That's direct labor. And finally, D, factory rent. Again, that is also manufacturing overhead. So understanding how the different costs fall into different buckets will help you understand how to put some of these schedules together. Cull Lumber Company allocates overhead at the rate of $7 per direct labor hour. Job A45 requires 4 boxes of direct materials at a cost of $33 per box and took its employees 20 hours to complete. The employees earned $16 per hour. So we need to compute the total cost of job A45. So we're going to look for direct materials, direct labor, and overhead. So our direct materials is the 4 boxes at $33 per box. Direct labor is going to be our 20 hours at $16 per hour. And since we allocate overhead at the rate of $7 per direct labor hour, we take those hours again, times $7 to get our overhead. Total cost of job A45 is therefore $592. Number 6, Sandhill Company applies manufacturing overhead based on direct labor hours. Information concerning manufacturing overhead and labor for the year is as follows. We have actual manufacturing overhead, estimated manufacturing overhead, direct labor hours incurred, and direct labor hours estimated. Compute the predetermined overhead rate, and we need to round our answer to 2 decimal places. So example 15.25. So make sure you read the whole question when you're taking the exam and see how they want you to round certain things. If it doesn't specifically say, then use normal rounding. If you're talking about dollars or a rate, it would be 2 decimal places for cents, for example. But a lot of the questions do specify what you should round to. So we want to calculate our predetermined overhead rate at $1 per direct labor hour. Okay, so to do overhead rates, we're going to take our estimated overhead divided by our estimated activity. So in this case, our estimated is 174,000 divided by 5,000 hours estimated to get $34.80 per hour. And then a follow-on question could be if we applied that, use that rate for this scenario, would we be over or under applied? So you take direct labor hours incurred times the rate and compare that to your actual manufacturing overhead. If your rate times the hours is more than 180,000, you would be over applied. If it was less than 180 hours, you'd be under applied. Okay. Number 7, it is necessary to calculate equivalent units of production in a department because A, physical count of units is impossible. B, the physical units in the department are always 100% complete. C, at times the department may use job order cost system and then switch to a process cost system. Or D, some units worked on in the department are not fully complete. And the answer is D, some of the units worked in the department are not fully complete. So therefore, we look at the percent complete to get equivalent units. Number 8, calculate some equivalent units. So in the month of June, a department had 23,000 units in beginning work in process that were 70% complete. During June, 94,000 units were transferred into production from another department. At the end of June, there were 11,000 units in ending work in process that were 30% complete as to conversion costs. Materials are added at the beginning of the process while conversion costs are incurred uniformly throughout the process. So for materials, we're 100% complete because it's right at the beginning. But this is asking for the equivalent units of production for conversion costs for the month of June using the weighted average method. Okay, so to get the equivalent units, we have to look at units that were started, what's left, and what was transferred out. The missing piece we have is what was transferred out, so we have to look at our physical units to figure out what we completed and transferred out. So we do that by taking the beginning work in process, 23,000. Since we're doing physical units, we aren't paying attention to what the percent complete is at this point, so we take all 23,000. We had 94,000 units transferred in from another department, so we add that. Then we subtract our ending work in process, our 11,000 units. Again, we're counting the full units because we're talking physical units, and that gives us 106,000 units complete and transferred out. Now that we have that, we can calculate our equivalent units, where we start with that number, the units complete and transferred out, and then we add the work in process, in this case the 11,000 units at 30% complete, so 11,000 times 30% is 3,300. Add that to the 106 that we completed and transferred out, and our equivalent units is 109,300. So answer B. Number 9, Waterway Industries has the following overhead costs and drivers. Direct labor hours are estimated at $100,000 for the year. The following information is available regarding activity cost pools, cost drivers, total estimated overhead costs, and estimated use of activities per product. So we have 5 activity cost pools: order and receiving, machine setup, machining, assembly, and inspection. Each of those have unique cost drivers. So orders for ordering and receiving, setups for machine setup, machine hours for machining, parts for assembly, and inspections for the inspection department, or the inspection cost pool. We have our estimated overhead for each of these cost pools. Then we have the cost driver. So it's a number of whatever that cost driver is. So order and receiving is orders, machine setup, setups, machining hours, machine hours. Assembly is the parts, and inspection are the number of inspections. So if overhead is applied using the traditional costing method based on direct labor hours, the overhead application rate is, so no matter what method we're using, we're going to use the formula that our overhead rate is our estimated overhead divided by our estimated activity. So if we're doing it based on direct labor hours, our activity is direct labor hours that we're estimating at 100,000 for the year. We add up all of the estimated overhead and do that calculation. So $3,593,000 of overhead, and that's just the sum of the 5 cost pools, divided by 100,000 hours, $35.93 per hour. So that's our traditional costing. That's what we would apply overhead based on direct labor hours. Now if we use that same data, but we're going to instead use ABC, we would calculate a rate for each cost pool, so we would have 5 rates. So this question here says, what's the overhead application rate for inspection? So we're just going to look at the inspection cost pool. Cost drivers inspections, we have $300,000 of estimated overhead. 500 is the cost driver. It's the number of inspections. So we use the same formula. The rate equals estimated overhead divided by activity. In this case, it's the $300,000 divided by 500 inspections. So it's $600 per inspection. So that's the overhead application rate for the inspections. And again, we can do the same for each of the other cost pools, and then when we see what the actual drivers are for each of these activities, we can apply that as the application of overhead. The idea, again, with ABC is to get it closer to the true activity that drives the cost in a given cost pool or department. These next 3 are some just some quick questions on definitions. So 11, a cost that varies in total directly and proportionally with changes in the level of activity is it fixed, variable, mixed, or product cost? So if it varies in total and it's directly and proportionally with changes in the level of activity, it's a variable cost. Cost that remains constant in total with changes in the level of activity this case, it's fixed cost. So the fixed costs don't change, especially when we're talking within the relevant range with the change in level activity. And then finally, a cost that varies in total, but not proportionally with changes in the level of activity. Is that fixed, variable, mixed, or product cost? And that's a mixed cost. So some portion is fixed, some portion is variable. So it's going to vary with activity, but not proportionally because they've got the fixed portion of that. And then if we have mixed costs, we can look at different months in this case of cost and activity. And we apply the high-low method to this data set to find out our unit variable cost. So how we do that is we look at the month with the highest cost and activity. So April in this case, 92,000 miles, $160,000. And we take the lowest level of activity. That would be February, 52,000 miles, $110,000. We take the difference in cost between the high and low divided by the difference in activity between the high and low. And in this case, $160,000 minus $110,000 is $50,000. 92,000 miles minus 52,000 miles is 40,000 miles. So $50,000 divided by 40,000 miles gives us a variable rate of $1.25 per mile. So if we use that same data, we can calculate our fixed cost. In order to calculate the fixed cost, you take the total cost. You can either use the high level of activity, April, or the low level, February. I'm going to walk through the example using the high level. So we take the variable cost rate that we just calculated times the activity to get our total variable cost. We take our total cost minus that variable cost. The remainder is fixed cost. So it's the total cost at the high level minus the variable cost at the high level. Variable cost again is the rate times the activity. So $1.25 at 92,000 gives us variable cost of $115,000. So fixed cost is our total cost of $160,000 minus our variable cost of $115,000. So the fixed cost is $45,000. I picked the high level, the data from April. You can also use the low month, in this case February. You would apply the $1.25 times the 52,000 miles to get the variable cost for February. Subtract that from the $110,000 of total cost for February. You would come up with the same answer of $45,000 for the fixed cost. So pick one when you go to the fixed cost, high or low, it doesn't matter which one, but everything you do on that is it's got to be at that same month. Whereas in the getting the variable rate, you take the difference between the high and low for the cost and the activity and do the division. So Duck Company sells two types of golf clubs. Sales mix is 30% for the basic, 70% for the deluxe, based upon quantity of units sold. Basic has a unit variable cost of $120 and a selling price of $160. Deluxe has a unit variable cost of $105 and a unit selling price of $225. Duck's fixed costs are $648,000. What is the weighted average contribution margin? So if we think about selling price minus variable cost, that gets our contribution margin. That's from the CVP income statement. Sales minus variable cost is contribution margin. We can do that on a per unit basis. So we have the selling price of both and the unit variable cost of both models. So if we take um, the contribution margin of each times the sales mix percentage of each, add those together, we'll get our weighted average unit contribution margin. So the unit contribution margin of product 1 times the sales mix plus the unit contribution margin product 2 times that sales mix gives us our weighted average. If we did it for divisions, we could do that as well, or we could take the contribution margin percentage times the sales mix to get our contribution margin percentage. So both of these formulas are on the help sheet I put together. So if we apply that formula to our example, for basic, we have 160 selling price minus 120 variable cost is $40 contribution margin times the 30%. For deluxe, 225 selling price minus 105. So we have 120 contribution margin times 70%. If we add those together, we get $96 as our weighted average contribution margin per unit. 17 says how many units of basics would be sold at the break-even point. Okay, so the break-even point in units is our fixed costs divided by our contribution margin per unit. That gives us our number of units sold. Then we apply the number of units sold in total because we're using the weighted average contribution margin per unit. We can multiply it by the sales mix for basic at 30% to get the number of units sold for basic at the break-even point. So fixed cost minus contribution margin per unit, $648,000 of fixed cost divided by $96 of contribution margin that we calculated in 16 above, 6,750 units. But that's the combined units. So we need to apply that, apply the sales mix to that number. So 30% for basic times the 6,750 gives us 2,025 basic units at the break-even point. That's it for this review. Again, exam is due Friday, March 13th, not 14th. Sorry for that typo, 11:59. So Friday, March 13th is when the exam is due. Reach out if you have any questions, and good luck on the exam.